Good morning, everyone, and welcome back to Retirement Plan Academy, the Trust Company of Tennessee's monthly webinar series. Adam, we are back after a 2-month hiatus during the summer, feeling refreshed and ready to go. So good to see you again on camera. Adam Davies from the Trust Company of Tennessee is with me. Dan Nato coming in from JP Morgan. Dan is the local expert here to talk with us about Secure Act 2.0 today. Some of you may have heard a little bit about this and what's happening in DC with the legislation so far. Probably a lot more action in the next month or two, Dan, coming up with this. So we're going to get some expert advice from you, and we're excited about that. Before we get to that, we do have a few little housekeeping things. Number one is we want to hear from you all. So this is a lot of new information that's coming in, and it's a lot of pertinent information as it relates to if you're a plan sponsor or involved with your 401k or 403b plan. It's going to impact your company and your people directly. So you're going to have questions. Please, you see a question box on there, pop it in there. I might interrupt these guys as we go if I can get it the question in as we're on the topic. If not, we'll certainly allow time at the end. We have 3 different CE certifications today. One is SHRM, the second is HRCI, and the third is CPE. We have added CPE in the last few months. I am not as well versed as I should be on all that we have to provide for that. So let me use my cheat sheet and talk about that just for 1 second. For those who are here for CPE credit, a few key items. Number one is we're going to have at least 3 poll questions pop up throughout the presentation, so make sure you answer each of those. You must stay until the end and complete an evaluation at the end in order to receive their credit. And we will be in touch with you following the presentation, probably in the next day or possibly by Monday, to get you the certificate that you need. We have 3 objectives here for that group. Number one is to understand more about current legislation that's happening right around retirement plans at this time. Number 2 is to learn when significant changes could actually happen or could occur from this. And the third, and probably the most important, is to provide you all, plan sponsors or those who are involved within your company's retirement plan, with the tools you need to be proactive in the approach. So gentlemen, this is one more requirement. We actually have to show our ugly mugs one more time on here, and here we all are. Dan, you have more certifications than I put on here because I was afraid I would put the wrong R or the TM on there. But again, Dan is with us from JP Morgan and has about 40 years experience in this field. He deals with all the changes that are taking place all the time, and so this is nothing new to him. But this is probably, Dan, I don't want to speak for you, but maybe some of the more sizable changes that are being proposed. And so what we're going to cover today is, number one, a review of what happened with Secure Act 1.0, and then really get into, okay, that happened a couple of years ago, end of 2019. Now, what is this 2.0 that everybody's talking about, and start to learn about some of the key pieces to that. Gentlemen, sound okay to you?
Let's do it.
Sounds
all
great.
Right. Before we do, let's go ahead and talk with the audience, at least electronically anyway. And Bryson, who is behind the scenes, is going to launch our first poll question. So please take just a minute to look at that and answer that. And it says, what issues does Washington agree on? Number 1, the other side is wrong. Number 2, retirement reform. And number 3, finding new ways to tax. Adam, you left out a D, all of the above on here.
This is a tough one. I mean, I could see all of these getting votes.
We'll give it just a minute here and let everybody get a chance to answer this one. And then we will jump into what happened with Secure Act 1.0 before we launch into the new stuff.
Although personally, I'm polling for number 2.
And we will get the results here. The other side is wrong. That's probably what I would have answered too. Adam, you did get some takers on the retirement reform.
All right.
And, yeah, finding new ways to tax. Again, we should have included a D, all of the above there. So our apologies for that. But guys, with that, Dan, if you want to take over here, I'm going to let you launch into what happened with Secure Act 1.0, which I believe passed at the end of 2019. Is that correct?
That's exactly right. And it was really the first major legislation that we had seen in about 13 years since the Pension Protection Act. And you mentioned, Zach, when I first started 40 years ago, it seemed like every other year there was some new pension law. But we went for a long time between the Pension Protection Act of 2006 and what is called the Setting Every Community Up for Retirement Enhancement Act. Now, that's a mouthful, so people call it the Secure Act. But and that question that you posed, which by the way, there was no wrong answer to those, all of the above certainly was right. But this bill, along with most other bills that relate to retirement plans, enjoy a wide bipartisan support. In fact, an earlier version of Secure 1.0 was called the Retirement Enhancement and Savings Act, and it passed the House of Representatives, and that's not a typo on this slide. It passed the House of Representatives 417-3. So that just shows you the amount of bipartisanship when it comes to retirement legislation. But it eventually got tacked on to a must-pass bill, an appropriations bill, which had this bill not passed, the government would have shut down, and nobody wanted that to happen. In the fall of 2019, it was signed into law by the president in December. And many of its provisions became effective last year, and the Department of Labor has been working on providing some guidance, but just a couple of things that were in this bill, and perhaps many of our listeners here today are familiar with some of these. It increased the starting age for required minimum distributions from 70.5 to 72. It accelerated the distributions to non-spouse beneficiaries after the death of a plan participant or an IRA account holder. Now, generally, those non-spouses have to take the money out within 10 years. It also enhanced a tax credit to encourage small employers to set up retirement plans. Now, small employers can take a tax credit of up to $5,000 per year for the first 3 years after they set up a plan. And it added another credit for small employers who want to add automatic enrollment to their plans. And it had a number of measures to try and encourage plan sponsors to think about lifetime income, providing lifetime income within their 401k or other defined contribution plan. So those are just a few of the things that were in the Secure Act. But there were a lot of other ideas floating around Congress at that time, and even since the Secure Act passed, that didn't make it into the Secure Act. And so therefore, Congress is going to take another shot at it. So if we go to the next slide, Zach.
Sure. And can I ask one question on that?
Sure, yes.
The one thing you said is the 10-year rule, right? And that is, and I'm going to go ahead and go to the next slide, but the 10-year rule is just to clarify that, anybody who is a non-spouse beneficiary, with a few exceptions, but typically if it passes to the next generation, to the children, they must take out any retirement account money that they've inherited within 10 years, correct?
Correct. It's actually by the end of the 10th year following the year of death of that participant or IRA holder. And as you say, Zach, there are some exceptions to that rule. And it's really one of the things in the Secure Act that really took a lot of participants by surprise, IRA holders by surprise, and also financial advisors who have been advising some of their higher net worth clients with big balances in plans and IRAs to who are telling their clients, maybe you can leave it to the kids and the kids can take it out over their life expectancy to spread out the taxation over their life expectancy. Well, unfortunately, that's not going to work anymore. So anyway,
Dan, I think that's an interesting point of that bill, is that there were so many great things that came out of it, increase in the RMD age, the tax credits, various other measures. Probably one of the reasons why it had such, unwavering support in Congress. But I know that's something we were kind of looking for in Secure Act 2.0 is, if they're giving up all these great things, what are some things that they're going to be potentially taking away? What are those revenue raising measures? Because typically with legislation like this, we see that, if they give you some great features, they're going to take some away so that it is neutral from a revenue perspective.
And indeed, that is the plan here. And what I'd like to do is actually kind of show some of these tax benefits that they're going to be providing in this bill, and then show you the ways that they think about trying to capture some of that lost revenue, which, as you say, they always will. So that is another reason why the third question in the polling question, Congress is looking for new ways to tax. We'll show you how. Okay. All right. So Secure 2.0. I kind of look at this moniker as kind of a shorthand way of describing the next major retirement plan bill. And so far, there are two major bipartisan bills, one in the House, one in the Senate, that have been introduced by some very senior members of Congress that have been championing retirement legislation pretty much all their career. In the House bill is called the Securing a Strong Retirement Act, and the Senate bill is called the Retirement Security and Savings Act. And these are massive bills like the Secure Act with a lot of provisions, but there are a number of provisions in common. And just to kind of set everybody's expectations, what's the process going forward? Well, here's what will happen. The House of Representatives, the House Ways and Means Committee, has already passed unanimously their version, the Securing a Strong Retirement Act. The Senate has yet to have a hearing in their committee, but we expect that to happen here in the next several weeks. And then, assuming they pass out of the various committees, then each body has to pass the bill. But there will be some differences. So Congress will put together a committee that is comprised of members of the House and members of the Senate, and they'll hammer out the differences. And then ultimately, a final bill will pass. In the meantime, there's some other ideas floating around that aren't in either of these bills that other members of Congress will say, well, I'll definitely support your bill, but there's something I've been thinking about for years that I want to see in this bill. So that give and take will no doubt be happening along the process. So given the fact that Congress has a lot on its plate, aside from retirement legislation, as we all know, just by following following the news, the chances of all that happening by the end of 2021 are pretty slim. It's a possibility they could rush something, but it is pretty slim. So we're really thinking that this is something that is likely to be hammered out and passed and on the president's desk sometime, perhaps in the first half of 2022. Now, if that happens, most of the provisions that we'll talk about will likely be effective in 2023. But even though Secure 2.0 and the effectiveness of Secure 2.0 is a ways off, I don't think it's too soon for plan sponsors, the folks on this call, to start thinking about how this could affect your plans. So with that, then let's look at the provisions that are some of the key provisions that are common in both the Senate and the House bill. So Zach, we'll go to the next slide.
Sure, and Dan, one quick question on that. I believe Secure Act 1.0 was passed in December of 19. Was that December? Is that correct?
Correct.
Yeah. And I have no idea if that was just happenstance or if that was them rushing to get it in so that things could take place for 2022. Do you think will there be maybe that same push to try to get this done to take effect in 2022?
It really depends on how earnest the key sponsors of these bills are to get something attached in some kind of a must-pass bill by the end of the year. JP Morgan's Washington relations folks are kind of telling me that, given all the other stuff on the plate of Congress, it's not as likely as perhaps it would have been earlier in the year that it will happen this year. So it's probably, as they say, more likely to happen sometime in the first part of next year.
Great, thanks.
Okay.
And you had mentioned that Secure Act 1.0 was attached to that spending bill and kind of rushed through, last minute. What do you think the chances of this being passed as a standalone piece of legislation, or do you think it would be attached to another bill?
If history repeats itself, and this is going back a number of years, typically these do not move as separate standalone bills. So typically they are attached to some other bill. So I suspect that's what will happen here as well. Okay. Any other thoughts? Okay, let's look at some of the key provisions that are in both the House and Senate bill, and one that is also it was introduced in separate standalone bills is permitting 403B plans to invest in collective investment trusts. Now, for those of you who aren't familiar with 403Bs, these are kind of like a 401k plan, but they're only available to 501c3 not-for-profit organizations like hospitals and private universities and so on, and public schools. Under the laws that exist today, however, 403Bs can only invest in annuity contracts and mutual funds. And that's the way it's been for decades. But there's been a lot of interest among that cohort, among 403B sponsors, just like 401k sponsors, to reduce the cost of the investments in their plan. And a lot of participants are demanding that as well. And collective investment trusts tend to be cheaper, less expensive investment vehicles than mutual funds or annuity contracts. So this is one that has a lot of support throughout the college community and other constituents, and certainly a lot of bipartisan support in Congress. So we very much expect this to be part of a final bill which comes out of Congress. The next change, I had mentioned Secure 1.0 improved a startup credit for small employers. And small employers in that context means 100 or fewer employees. And they increased the maximum amount of that credit to $5,000 for costs associated with setting up a plan. But under that provision, a small employer can only claim as a credit half of the amount of those startup costs. Well, this provision in Secure 2.0 would say if you're a small employer with 50 or fewer employees, rather than only being able to claim as a credit half of the cost, you would be able to claim as a credit 100% of the cost, up to a maximum of $5,000. Again, trying to encourage that even smaller employer to set up plans. The next change has an awful lot of support throughout various constituencies, and that is allowing employers to make matching contributions on behalf of employees who aren't contributing to the 401k plan, but they're paying off student loans. A lot of employees come out of school with huge college debt, and perhaps they can't participate in the 401k plan because all their available cash is servicing that college debt. Well, this would allow employers to say to that employee, hey, let me know that you are paying off college debt and give me some information to verify that you're doing so, and I will make a matching contribution to the plan, just like I'm making a matching contribution to those employees who are actually contributing money to the plan. Now, this became popular, this idea, and it was talked about after a few years ago when the IRS issued a private letter ruling to one company who wanted to do something like this. Now, this company, who we've later learned was Abbott Labs, received that private letter ruling. And so that company, Abbott Labs, can rely on what the IRS said in that letter ruling. But the thing about a private letter ruling, it can only be relied upon by the taxpayer, in this case, Abbott Lab, that sought and received the letter. So it's only good law, if you will, to Abbott Labs. This change would make this sort of a provision available to any employer who wanted to add this feature to its plan. So Adam, I know you've thought about this a lot and done a lot of research on this. What are your thoughts on this?
Yeah, so this is something we've been following closely because it's probably one of the more unique provisions in this bill. And if this is your first time joining us, we did do a webinar on this in April, and it was probably one of our most well-attended webinars. So I think there is a lot of interest in this topic. You know, if you think about Abbott Laboratories, the way they actually structured this was if employees contributed 2% of their pay to the 401k plan, they would get a 5% employer contribution. And so they really wanted to emulate that same thing, but for those employees who weren't able to afford to save for retirement. You know, if you think about Abbott Laboratories, they hire a lot of engineers and medical workers that might have student loans. And so essentially, as long as they could pay down 2% of their student loans, Abbott Laboratories still gave them that 5% into their 401k plan. You know, since that private letter ruling was issued in 2018, we've seen a ton of interest in this both in Congress and from employers. I've seen this attached to several pieces of legislation that haven't passed yet. And so the fact that it's now made its way to Secure Act 2.0 something that does have a lot of support in Washington. I think this is something that could be available to plans in the future, but as Dan said, right now it currently isn't just available to Abbott Laboratories for that private letter ruling. So, for me personally, and at the trust company, this is something we're watching very closely, because I think a lot of plans are going to be interested in this, once it does get passed.
Two
Yeah,
quick questions.
definitely will be a lot of takers, certainly. I'm sorry, Zach.
No, you're fine, Dan. This has been our hottest topic, of the year as we go through this. And two quick questions on that. So I want to clarify this, Adam. Number one is, and let's use a random. Well, let's use Abbott. They were what, 2% and 5%, 2% individual, 5% company.
Yes, sir.
Right. So if this comes to fruition, then the employee is paying towards their student debt and the employer is paying towards their retirement, correct?
Correct.
Okay. And guys, and Dan, this might be you as well. We don't anticipate any scenario where a company can go away from their current match, right? You can't have two different matching formulas, one for some employees and one for student loan employees, correct?
Yeah, that would be very difficult to administer and satisfy all the so-called non-discrimination rules and so on. So it's likely going to be the same match as you would have to somebody who's actually contributing.
Gotcha. Thanks.
Okay, a couple other things I'll mention that are in both bills. Simple IRAs permit those contributions to be made on an after-tax Roth basis. Right now, under the rules, companies with simple IRAs, their employees make pre-tax contributions, pre-tax deferrals to these types of plans. The next change would bump up the catch-up contribution amount for people at certain ages. Now, there's a little difference between the House version and the Senate version. The House says if you're 62, 63, or 64, you'd be able to make a catch-up contribution to your plan of $10,000. Right now, the catch-up amount for people age 50 or older, which guilty, is $6,500. This would raise that to $10,000 for people in that age category, but in the Senate, if you're 60 or older, you'd be able to make a catch-up contribution of $10,000. More on that topic a little bit later when we look at how is Congress intending to have this provision paid for. The next one is something that would actually make a change to something that the Secure Act created. And that is, the Secure Act has a provision that says if you are a sponsor of a 401k plan and you have long-term part-time employees, you have to allow them into your plan after 3 consecutive 12-month periods in which they work at least 500 hours. That's what the Secure Act said. So a long-term part-timer, at least 3 consecutive years where you've earned or where you've worked more than 500 hours, you have to allow that employee to contribute to your 401k plan. You don't have to make a matching contribution for them. You could if you want, but you don't have to. What Secure 2.0 would do is allow those people in a year earlier. In other words, having a 2-year waiting period rather than a 3-year waiting period. So already Congress is thinking about tinkering with something they just passed very recently. So this would be a change. Now, one thing I perhaps you guys have spoken with your plan sponsor clients about, this Secure Act provision, the 3-year eligibility for people with 500 hours or more, is one that you don't have to count hours of service prior to 2021. So it's 2024 that under the Secure Act that you have to start allowing these people in the plan. But you want to make sure, and perhaps you've talked to your clients already about this, that they have ways of tracking this cohort of participant, of employee, so that you can indeed let them in the plan at the appropriate time. Failure to do so is a potential plan disqualification event.
Definitely. And so if I think of the overall philosophy of Secure Act 1.0 and 2.0, Washington's really trying to encourage more access to retirement plans. A lot of people say, and I think correctly so, that there is a retirement crisis and that, not everyone has access to a 401k or a 403b. And so, you see their startup credits. That's definitely trying to encourage more small companies to offer plans. This provision for working, part-time and letting people in sooner, definitely trying to expand access to more folks, and probably one of the reasons why this is getting such bipartisan support, in my opinion.
Yeah, absolutely, absolutely. All right, let's look at the next slide and just talk about a couple of other provisions that are in both of these bills.
Okay, before I do, Dan, can we go into one more poll question for the audience?
Oh, sure, absolutely.
Excellent, good. Bryson, who's behind the curtain there, will launch that for us in just 1 second. I believe we now have it. There we go. So, what age is ideal to require participants to start taking RMDs? Is it 70 and a half, 72, 75, or never? And I guess, Adam, I think you came up with this question. I guess it depends on if you're looking at it through the lens of the person or the government. Is that fair?
Definitely, and just for anyone on the call that might not be familiar with the term RMD, required minimum distributions, essentially when does the government force you to take some of your pre-tax money out of your qualified retirement plan in order for them to tax part of that? So I'm curious to hear what everyone's thinking.
Yeah. And we will launch results in 1 second. Here we go. And 70.5 gets the majority, but you see it's a pretty even split across the board. Any comments on that?
Well, if you're looking from the standpoint of the government, it's 72. That's the age that was increased. It was increased to thanks to the Secure Act. It had been 70 and a half for many, many years. But I guess if you're one that doesn't want to pay a lot of tax during your lifetime, you'd probably want to say never. So
I was actually expecting a lot more nevers.
That's right.
So, which actually is a great segue to the next provision I wanted to talk about, and that is one of the provisions that's in both bills is to increase that required distribution starting age to 75. We mentioned that the Secure Act raised it to 72, and this would increase it yet again to 75 to allow us to keep our funds, if we want, in our tax deferred retirement accounts, IRAs and 401k plans. So another change is actually was in a couple of standalone bills, and this was in some bipartisan standalone bills that would create what is being referred to as a retirement savings lost and found. And this provision would require the federal government to set up a portal, a web portal that would allow an individual to go online to that portal and see if they've forgotten about any retirement benefits they had somewhere else. And apparently this can happen. Let's say, for example, you worked several years ago for a company and you accrued a small amount in the defined benefit plan, but you just forgot all about it, or maybe weren't aware that you had accrued, a $500 a month pension from that plan. Or perhaps you left a job that had a 401k plan and you had, say, $8,000 in that 401k plan and it just slipped your mind and you forgot about it. This would allow people to go online and find those benefits, and then there would be information to allow you to get in touch with the plan administrator so that you can claim those benefits. So this would actually be kind of a nice thing and probably help a lot of people out.
Dan, when I saw this, I was actually thinking back to a call I once received from a participant, and it's hard to believe that these things happen, but got the phone call from the participant, and they said, hey, I just got a statement from you all, and it says I have 180,000 in a 401k plan. Is that right? And so, of course, looked her up, and sure enough, she had contributed for many, many years, left the employer, forgot about it. And so you can imagine how excited she was to learn that she suddenly had 180,000 more than she thought she had. So I think this is a great way to try to connect those folks.
That is incredible. That is a heck of a story. Well, so now that has me thinking, did I leave some money behind in a plan? No, not very likely. I will, if this can be somewhat confessional, I will say that I did something very, very bad while I was in law school. I had accumulated a very small amount in a profit sharing plan from an employer. This was even before the days of 401ks. And I realized, you know, I got a statement that said I had $1,500 in this profit sharing plan. I said, oh, great, I'll take it. So I took the $1,500. I was in a very, very low tax bracket. I was a student. I paid the tax, paid the penalty, and who knows what that amount of money would be today. So so at any rate, I wish I had forgotten about it, and then I got that I got that statement in the mail. So anyway, uh, the penalty if we talked about required distributions, if you don't take one, there's a very nasty 50% penalty on the amount you should have taken. Secure 2.0 would soften that a bit to 25%. Still pretty steep, but soften it. IRA contributions are limited to $6,000, and if you're age 50 or over, there's a catch-up amount of $1,000. So somebody 50 or, did I say 60? I meant 50. Somebody 50 or older could put in $7,000 to an IRA, but that catch-up amount of $1,000 is not indexed. This would index. And the final one that I want to mention that's in both bills has to do with a type of annuity contract that was authorized by the IRS a few years ago that basically gets around the required distribution rules. It's called a qualifying longevity annuity contract. And this is a type of an insurance annuity contract that is deferred, and you don't have to start taking payments out of this contract until either 80 or 85 is typically the maximum. And you can put a certain percentage of your retirement dollars into one of these things. And even though you're over age 72, you don't have to start withdrawing from this deferred qualifying longevity annuity contract until the contract term says it starts to pay out. 80, 85, somewhere in there. What this would do is it would improve those by saying you could put up to 100% of your account balance to a maximum of $135,000 into one of these. Right now, so you can only put 25% of your retirement balances into one of these things. So I don't think the QLAC market has really caught on. Part of it has to do with the lower interest rate environment that we're in today. But eventually, if this change were to happen and we would see a different interest rate environment, QLACs could be a way that a lot of people would attempt to not outlive their retirement savings by stashing some of their money into one of these types of annuity contracts.
Dan,
okay.
if I could circle back to the RMDs for a second.
Sure.
My understanding of the bill is that increasing that RMD age to 75 would happen over a period of time. You know better than I, but I believe it jumps to 73 January 1st, 2022, 74, 2029, 75, 2032. If this doesn't get passed until next year, you know, how do you see some of those ages being adjusted?
Yeah, typically what happens when a bill is written with effective dates and then the bill doesn't pass until a later year, all those effective dates are typically adjusted by, let's say, 1 year in the case that this passes in 2022. So that's what I would suspect would happen, Adam.
Awesome.
Got it. And Dan, on the next slide, we're about to launch into two of the biggest trends in the retirement plan space in terms of auto enroll and auto escalate. So Bryson, if you don't mind, let's go with poll question number 3 for the audience. Get some feedback from them on what's happening with their plans right now. And you'll see the question is, what auto features are currently utilized in your plan? And we're talking about auto enrollment and auto escalation. And guys, I think that these two pieces, along with and the Roth has been coming along faster than these two have, but these two, along with the addition of Roth 401ks, are probably the 3 biggest trends we're seeing. Do you agree?
Oh, definitely.
Oh, yeah. Absolutely.
Yeah. And we'll chat a little bit more about what's going to happen, well, what might happen, I guess, with Secure 2.0 as it relates to auto enroll and auto escalate, and just get a sense of who might already be doing that, how popular it actually is amongst this group. And you'll see that the bulk of this, the majority are doing auto enrollment right now, not auto escalation, but some are doing both of those. So yeah, pretty good results, you know, and none, right? This is something that I think this is really maybe guys over the last 3 to 5 years has picked up a lot of popularity. Is that fair to say?
Absolutely. The Pension Protection Act of 2006, which was the previous major pension law, did a lot to encourage automatic enrollment. And I think since that time, and perhaps you guys have seen it as well, we've seen many, many more plan sponsors add that feature to their plan. Just to describe a couple of things that law did to make automatic enrollment more palatable to plan sponsors. The Pension Protection Act created the idea of the qualified default investment alternative. Prior to the qualified default investment alternative, a lot of plan sponsors were a little leery about automatically enrolling somebody in their plan, taking money from their paycheck, putting into the plan, and then the plan sponsor had to decide where it's to be invested. So a lot of plan sponsors just put it into a money market fund, which didn't offer much promise for growth. The qualified default investment alternative rules, which came about in the 2006 change, allowed plan sponsors to put it in something that has more of a growth potential, typically a target date fund, which is one of the authorized QDIAs. So what we see in Secure 2.0 and the Senate's version of the bill is yet a new automatic enrollment safe harbor. And just to describe what a safe harbor means in this particular context, this is a type of a plan provision that would allow the plan to not have to do the so-called ADP and ACP tests, which are tests that test for non-discrimination in a 401k plan. And it also if you satisfy one of the existing safe harbors, you don't. The plan is not top heavy. You don't have to follow the top heavy requirements. So right now, there's two safe harbors that are available to plan sponsors. Perhaps some of you, your clients, use those. Well, this would create a third one with a name called the Secure Deferral Arrangement, and this would require, if you plan sponsor chose to use this design, it would require automatic enrollment with an initial contribution rate of 6% of pay. And I think many of us believe that a lot of employers, if they do have automatic enrollment, start with a 3%. But if you don't have auto escalation, people tend to stay at 3%, and that's probably not enough for those participants to accumulate a substantial sum for their retirement. So this is trying to encourage plan sponsors to start the automatic enrollment at a higher rate. In this case, 6%, and it would require auto escalation up to 10%. And like the other safe harbors, this would require a financial commitment on the part of the plan sponsor by requiring the employer to make a matching contribution, and you see the rate there, dollar for dollar on the first 2% of pay, then 50 cents on the dollar on the next 4, and then 20 cents on the dollar on the next 4. But if you add that all up, for a participant contributing 10%, the match rate would be 4.8%. Now, I mentioned that one of the other automatic enrollment safe harbors has a match commitment of 3.5%. So I scratch my head and I think, well, why would an employer want to do this one when you could have a safe harbor with automatic enrollment and only have to make a matching commitment of 3.5%? Well, one inducement could potentially be what is also built into this bill, and that is for those smaller employers, 100 or fewer employees, the employer would get a tax credit for the contributions that they make to the non-highly compensated employees if they adopt this arrangement. It's a tax credit that expires after 5 years, so then the employer would be obligated to contribute the entire 4.8% for somebody who's contributing 10%. So again, it's not sure that this one is going to catch on. Might cause more confusion, but the senators who put this in their bill, are committed to this notion, and could very well be a provision that winds up in the tax code that not many people use. We'll see.
Boy, I know when you were describing this, I thought that's certainly a mouthful, and I can imagine trying to go to participant meetings, employee meetings, and trying to explain this match formula. So personally, I hope this gets simplified a little bit.
You know, and given the fact, Adam, that this is only in one of the bills, perhaps to kind of save a little paper from the U.S. government printing office, maybe this one gets cut out because it does take a number of pages in the bill. So we'll see. We'll see. But what change, though, that does have it actually had, it wasn't in the House version of the bill, but it has a lot of support on a bipartisan basis, and that is to improve the so-called Savers Credit. The Savers Credit is a credit that has been on the books for a number of years that allows lower and moderate income workers to get a credit up to $1,000 for up to one half of the contributions that they make to an IRA or their employer-sponsored retirement plans. Now, this credit could be a very good deal, but there's a couple of problems with it under the existing law. Number one, it's only available for lower and moderate income people. So, for example, if you are you're married and file a joint tax return, and your adjusted gross income is more than approximately $66,000, you can't take this credit. But the bigger problem is the fact that this credit is not refundable, which means if you don't otherwise owe federal income tax, if your income is low enough to qualify for the credit, but so low that you don't owe any federal income tax given your deduction and so on, this credit is not refundable. The bill would make the credit refundable. And the way it would work is this. If you qualified for the credit and you made a contribution to your 401k plan, and that's what qualified you for the credit, Uncle Sam would deposit your refund to your plan. So that would require some piping between the U.S. Treasury and various plans. So record keepers, would have to figure out how to hook up with the government to be able to, to accept these credits and so on. But there's a lot of support. In fact, I might also mention that there has been considerable talk about including this particular provision in a what's called a reconciliation bill. And a reconciliation bill is a bill that has some tax implications that can go through Congress on a simple majority basis. It doesn't require the 60 votes in the Senate. So in other words, the party who controls both the House and the Senate and the White House can put through a reconciliation bill without the approval of the other party. We've seen reconciliation bills go through Congress over the years on this sort of a basis. So there's talk about having this provision find its way in a reconciliation bill, which could very well pass before the end of the year by the Democratic majority without any Republican support. So this, of anything that we'll talk about today, this is probably something that we could see before the end of the year.
Interesting.
Yeah. Okay. And the next one is another tax credit for that small employer that, again, 100 or fewer employees that add an automatic re-enrollment provision to their plan. And by that, this means that you periodically do a sweep of those employees who have affirmatively opted out of your automatic enrollment program. Because if you automatically enroll somebody, they have the ability to say, no, I don't want to be in the plan. I'm opting out. That you go back at least every 3 years and do a sweep of those people who have opted out or who aren't contributing aren't contributing at least to the initial rate for new employees. And those small employers who add this feature to their plan would be able to have a $500 credit for the first 3 years after they add this feature. Again, trying to encourage people, and Adam, to your point, to try and encourage more participation in plans.
So if I think back to Secure Act 1.0, there were, of course, the $5,000 tax credits for starting a new plan. I believe there was also a $500 tax credit for auto escalation. So this would be then a third credit for automatic re-enrollment. So you could potentially get $5,000 plus $500 plus another $500 for 3 years.
Absolutely. So if you're that small employer, that's something you don't want to leave on the table. Take advantage of all of those options. Okay, let's look at the next slide. And now we're going to look at the provisions that are only in the House version of the bill. And this first one on this chart is really quite amazing. And this would be a rather expensive provision for Congress. Again, Adam, we just talked about a number of credits that Congress has dangled out there for small employers to get them to set up plans. Well, this is a credit that would allow those small employers to take a credit for the employer contributions that it makes to the plan. So, for example, the matching contributions it makes, and the credit would be up to $1,000 per employee for the first 2 years, and then it gets reduced down, as you see on that chart, for the first over the first 5 years, and then there's no credit. And the amounts that are shown on that chart would be the credits that would be available to employers with 50 or fewer employees, and then if you're between 50 and 100, those amounts get gradually phased out, depending upon how large of an employer you are. I've never seen anything quite like this proposed to really encourage that small employer not only to have a plan, which we saw the incentives to set up and plan and put in automatic enrollment, but also to make employer contributions to the plan. As I say, this is an expensive provision. Maybe it won't make the final cut, but if it does, if I were a small employer, I would certainly find this to be quite an inducement to make employer contributions to the plan, which means then I could set up a safe harbor 401k, which, as I mentioned, requires an employer commitment, a form of an employer contribution. And through this credit, I would be able to take advantage. I would be able to have the federal government help me make those contributions.
That does seem awfully generous, and I could imagine quite a few plan sponsors, seeing this tax credit and perhaps even increasing their match. And so, I mean, I think these would all be great things for the participant. The question on my mind is how will we pay for it?
And we will get to that question because that's a very interesting one, and Congress has some interesting ideas there. So let's look at we'll look at that in one moment. But before we do, let's cover a couple of other things that are only in the House bill. We talked about how Congress is trying to encourage automatic enrollment. Well, if this provision passes, any new 401k plan or 403b or simple IRA plan would have to have automatic enrollment. It would be required. You would have to have automatic enrollment if you set up a new plan. Now, everybody on the call presumably already has a plan, so and you would be grandfathered. So in other words, you wouldn't have to set up an automatic enrollment. Although, as we've mentioned, a lot of you have already done so, and we saw in the polling, the answers to the polling question, many of you have already done that. A couple of other things very, very briefly. The Secure Act created a new type of a multiple employer plan called a pooled employer plan. But what was not clear about in the Secure Act is that if a small employer joined one of those plans or joined the existing type of multiple employer plan, it wasn't clear that that small employer would be entitled to that new plan startup credit. After all, they were joining an existing plan. And so this would make it clear that a new employer who joins one of these programs would be entitled to that credit, just like an employer who sets up a standalone 401k or other type of plan would get the credit. So that would be very, very helpful. They would also allow 403bs to have these types of arrangements as well, the MEPs or PEPs. And then finally, there's a provision that would create yet another exception to the 10% early withdrawal penalty when people take money out of a plan prior to age 59 and a half. And this would be for situations where the participant, there's a situation of domestic abuse that affects the participant. And under this provision, the participant would be able to self-certify that there's some domestic abuse situation going on in their life, and they would be able to take withdrawals up to $10,000, pay the tax on that withdrawal, but not be subject to the 10% premature distribution penalty. All right, let's take a look at, and this is the question that Adam has been asking, and rightly so. if you add up the various tax breaks, the House version of the bill, because that's the only one that has been scored by the Joint Committee on Taxation, who kind of figures out how much or estimates how much tax revenue would be gained or lost. The tax breaks in that bill would amount to $27 billion over 10 years. And Congress is always trying to think of ways of making these things revenue neutral. And the way they've is proposed to do that, at least in the House version of the bill, is a couple of ones, and a couple of them are somewhat obscure, not that lucrative, if you will. But then a couple are some of the big ticket items, and we'll spend more time on those. But first, hardship withdrawals from 403B plans could include the earnings and other types of contributions. Congress made this change a few years ago for 401k plans, but 403B plans, hardship withdrawals are just limited to the participants' own contributions, not the earnings on those contributions. So this would create parity with 401ks and allow those earnings to come out. This is a revenue raiser, obviously, because if you take a hardship distribution and it includes more than your own contributions, there's more money coming out that gets taxed, and therefore the Treasury makes up a little bit more, that $27 billion over 10 years. We've already talked about a provision in both bills permitting simple IRAs and SEP IRAs to be made on a Roth basis. Here are the big ticket items. Requiring any catch-up contributions to employer plans, 403Bs, 401Ks, 457Bs, to be made on a Roth basis with after-tax money. Now, as I mentioned, I've been making catch-up contributions to the company 401k plan ever since I've turned 50 years of age. So that's been a little while now. And I've been making them on a pre-tax basis. I'm older than many of you on this call, and certainly older than Zach and Adam. I don't have as much time, even though a Roth feature is available in my plan, I don't have as much time to have the Roth money grow on a tax-free basis. So I've elected to put it in pre-tax and save taxation currently. This change would require me, should this become law, and I suspect it will, would require me to utilize the Roth feature of the plan. Therefore, those monies would be taxed in the current year. Now, granted, they would be in the Roth account within the plan, and they would grow tax-free when I take the money out. I wouldn't pay tax on those dollars. So this would be a big change and a big revenue raiser for the government to help to pay for many of those provisions in the bill. The next revenue raiser is a provision that would allow employees to tell their employer to make any matching contribution on an after-tax Roth basis. Put that money in a Roth account. Right now, when an employer makes a matching contribution, that contribution is basically pre-tax. In other words, when that match comes out of my plan, I'm going to pay tax on that matching contribution plus the earnings on that matching contribution. This would allow employers, it wouldn't require an employer, it wouldn't be a mandatory feature, but it would allow an employer to have a provision in its plan whereby employees could tell the employer, I elect to have you make any matching contribution into the Roth account. Now, the employee would have to pay tax currently on that matching contribution, presumably, and the detail is not in the actual bill, but presumably the IRS would require that match to be reported perhaps as W-2 wages, but in any event, I would be paying tax on that contribution that my employer makes as a match. So that would allow, in fact, it would be a great planning technique for younger employers. My dear colleague, Catherine Roy, is our retirement strategist who spends a lot of time working with plan participants and financial advisors and so on. And she really touts the benefit of the Roth feature of 401k plans for younger employees. In fact, she tells a story. When we get new analysts hired here at JP Morgan Chase, one of the training days has to do with some of the benefits, and one of the benefits, of course, is the 401k plan that we have for employees here. And she talks to these employees about retirement planning, even though they're 22 years of age. But she talks to them and she says, if I hear that any of you are putting money pre-tax into the 401k plan, you're going to hear from me, because the Roth feature for a 22-year-old is a tremendously powerful benefit. I wish Roth was around when I was 22 years of age. It was not. And if that employee could say, and by the way, employer, I want the matching contribution to be in Roth as well, all that money that would be accumulating over that employee's 40-year working career would then come out tax-free. Really a powerful, powerful thing, potentially. So, this idea of using the Roth feature of retirement plans to raise revenue for the U.S. Treasury has been around for a while. Let's take a look at the next slide, Zach, because I think it's kind of interesting to see the notion of the Roth. Unless do we have another polling question that we need to?
We don't know. I wanted to point out, talked about proactive steps for plan sponsors on the call. This part to me is the most impactful. And Dan, was it Catherine that you mentioned? Yeah, she and I need to talk. Adam and I presented it along with one of our colleagues at the Tennessee SHRM conference last week. And Adam, I felt like I was selling Roth 401ks at one point. I'm such a believer in them for those exact reasons. I mean, just the years of compounding growth coming out tax-free. And as a financial planner, we see also the emotional impact, right? Where somebody's going to retire and they've got X amount of dollars, and 25% of that, or whatever rate it is, right, belongs to the government. And so Roth is a powerful tool. To the plan sponsors on the call, if or perhaps when this passes, this is where you need to put your advisor to work, right? Get them in there, just as Catherine does with your employees there, Dan. Talk to them, make sure they understand the impact of this, how it can work, and be sure that somebody can be there to advise on it and even persuade on it for different employees who may have different needs. So just something to have in mind as to who can help here and when to get them involved early and often, get them out there to explain this. And Dan, yeah, next page, and I'll let you continue on.
Yeah, so this has to do with how the government has used the Roth notion to raise revenue, and people call it Rothification. And going back to the actual creation of Roth IRAs, which became effective in 1998, we saw the creation then of Roth 401k accounts. Again, if I'm contributing to the Roth 401k, I'm paying tax on my contributions up front. The government's collecting money now rather than later. And then we saw that a change which became effective in 2010 eliminated what was a barrier to converting a traditional IRA to a Roth IRA, which was if you had adjusted gross income of over 100,000, you couldn't do that. And so a lot of people who perhaps wanted to convert their traditional IRAs to Roth because of their income level couldn't do so. So then the government says, okay, we'll take away that limit and we'll allow you to go for it. Plus, they said if you convert in 2010, we're going to allow you to pay the tax on that conversion ratably over 2011 and 2012. In other words, you can convert in 2010 and not pay tax in 2010 on that amount you bring over, but pay the tax in 2 installments over the next couple of years. In fact, I took advantage of this and created a bunch of traditional IRA money into a Roth IRA. And what was Congress doing? They were inducing me to put money in the tax system so that it could be taxed, and they got me. And another law change said you could do something similar if you had with your pre-tax money in your 401k, and again, pay the tax over 2 years. So you can see how Congress has used this idea to raise revenue over the years, and that's why it's not surprising that we see in Secure 2.0 the provisions that we just looked at on the previous slide.
Well, and if I think back to Secure Act 1.0, I know a lot of people were upset with eliminating that stretch provision. People couldn't take those distributions over their life expectancy. They were forced to do it in 10 years. That seemed to be pretty controversial. in terms of giving something up for all these great provisions, this really doesn't sound like that bad of a trade-off. I don't know if you have any thoughts, Dan or Zach.
No, I definitely agree. I definitely agree. I will suck it up and make my catch-up contributions on a Roth basis. I'll take one for the team. So no, you're absolutely right.
Yeah, I agree, Adam. And again, as a planner, that's if given the option to where our company's match can come to me on a Roth basis, I'll take that increased year-over-year tax, knowing that I've still got a long enough runway where I'm going to make up for it on the other side. So I'm the ones where they're going to get money back from me, I'm actually excited about. So it works out well there. But guys, we are up against the clock here. Dan, you've been wonderful, and we found you as a speaker out there. You're out there frequently, and we really appreciate you joining us for this. There's going to be more to come, so maybe we could all get back together as this continues to go. But to the plan sponsors on the call, yeah, again, now's the time to get with your providers, with your advisors, talk through some of this, be sure that you're communicating about what might be coming here, how best to work with your participants. And if you have any general questions about that or about your plans, whatever it may be, feel free to reach out to us. We do have another monthly webinar coming up, I believe September 23rd. Keep an eye out for communication around that. Dan and JP Morgan Chase, thanks so much again for being here. We really appreciate it. And to all of you, have a great day.